Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and I have a very special guest edition of the Fintech Takes podcast today. I am delighted to be joined for my guest today by Tim Bates, principal at Efficient Frontier Risk Strategies. Tim, thanks for coming on.
Hey, thanks, Alex. It's a pleasure to be here. I'm a big fan of Fintech Takes and really looking forward to this.
Well, you're very kind to say so. It's interesting actually because our paths have crossed, I think, multiple times
Mhm.
over many years now. So, by way of introduction for the audience, would you mind giving just a quick background on yourself and what you're doing now, and then we'll jump into the discussion.
I have been in and around some form of risk management in banking, be that either credit, fraud, or enterprise risk for 25-ish years. I started off my career with the credit bureaus, actually building risk models
Hmm.
and doing work analytic consulting on implementation of them and making them work effectively. From there, I went over to the banking side. I was a senior vice president at Washington Mutual Bank back in the 2000s. And then went on to senior risk roles in a couple of credit unions. Most notably, I was the chief credit officer at BECU, which is one of the largest credit unions in the country.
Yeah.
I recently started my own consulting company because I wanted to help banks and credit unions and fintechs think about risk strategy more effectively, and then building help them build the infrastructure and capabilities that they needed to achieve those strategies.
Fantastic. Well, it's in that capacity most recently that I wanted to
Mhm.
have you on because for folks who are listening, Tim wrote a wonderful research report, Cash Flow Underwriting, a practical credit risk implementation guide for lenders, which I'm excited to announce will be the first in a new series of FinTech Takes research reports. So the idea basically is that I'm going to team up with various folks in my sort of broader network who are much, much more knowledgeable about important topics that matter to the FinTech Takes audience than I am. And they're going to write research reports that we're then going to distribute to you, the audience. And this first one on cash flow underwriting, it really is just outstanding. So, first things first, Tim, congratulations on the report. By the time folks are listening to this podcast, it'll either be live or it will be live soon. So, if you haven't seen it yet, watch for it. But Tim, thank you so much for putting the work into this. The report's amazing.
Yeah, well, I really appreciate it. It was a lot of fun to write. I spent I interviewed a lot of really interesting people that are they're really at the forefront of innovation around how they're using this data and the way that it's working. So it was a pleasure.
Awesome. Well, I can't wait for folks to read it, but we're going to give everyone a little
Mhm.
preview of the report
Right.
on in today's podcast. So, before we
Mhm.
get into some of the more detailed findings, I'm wondering if you can just start by giving us just a little bit of background on why you wanted to write a report on cash flow underwriting. What drew you to this topic?
This is something that I have implemented on us, if you
Mhm.
will, cash flow underwriting previously, just within my own team, and I recognize the challenges of kind of capturing your own data, within just within your own ecosystem and using it for cash flow underwriting. Um, when open banking came along and just the the potential that cash flow data offers when it's obtained the data is obtained through open banking. I really think that it has more potential than just about any sort of innovation that's come along in financial services and sort of our credit decisioning ecosystem, if you will. Credit data has been the foundation of that system for a long time. It is for lenders. I mean, when you're a lender, you really want certainty, and credit information. It's repeatable, it's reliable, there's an infrastructure around it, it's regulated, everybody understands it. There are all these complementary tools built on top of it, like FICO scores and all that, and it works really well. The biggest issues that I think most lenders have had with it are there are a couple of things. Number one, they're always looking to expand the universe of those from a financial inclusiveness perspective. And credit data, while it works great for everybody that's in the system.
Mhm.
If you either haven't had access to traditional credit, or just or new to credit or whatever.
Mhm.
There are fewer opportunities, and then lenders also wanted to improve the quality of the decisions they're making from a risk perspective. When you look at cash flow data, it really addresses both of those issues in a way that no other alternative data source has. And when I look at the potential of it, I think there are really broad implications for consumer control, ownership, and just how the data is obtained and used for the financial services industry. I see this as one of the biggest things that's coming along. In a number of years in credit risk.
Yeah, absolutely. Well, and just to put a sort of slight emphasis on one point that you made, there have been innovative lenders for a long time. Sounds like you were one of them who have been using on us, meaning sort of internal to the bank deposit data to enrich the underwriting decisions that they're making. But as you illustrated, the big sort of so what or why now with cash flow underwriting is open banking, right? And I've spoken to Director Chopra at the CFPB a number of times about this. Like the CFPB's work on rulemaking around open banking, it is explicitly focused on enabling specific use cases. And one of those use cases, maybe the most important use case, I think, to regulators, including the CFPB, is enabling cash flow underwriting to work at a broader scale, to work with data that the bank doesn't already have, but that a consumer can permission to them. So when folks think about like, is this a new thing? Is this something that's been around for a while? It's a little bit of both, but the why now is that we have a robust open banking infrastructure that we can rely on. So Tim, um, given your expertise and your many, many, many years of working in various sort of chief lending or chief risk management type roles, I want you to sort of take us to credit underwriting school for a moment, right? So I want to understand like how credit underwriting works, and then specifically where cash flow data can add value. So let's start here. A very sort of simple way to conceptualize the way that most lenders approach evaluating credit risk is the four C's of credit underwriting. Can you walk us through what those are?
Four C's, and they're quite simply credit, collateral, capital, and capacity. I think on the first day of loan officer training, these are the things that they teach you right after they give you a computer and a name tag and you introduce yourself. They are fundamental to lending, and I think and I've heard some people say that they might have been on one of the stone tablets that Moses brought down from the mountain. They're so
Right, right.
they're
They've been
so
around for a while.
core to lending.
Hmm.
Yeah, exactly. Among those four, I think, capacity has generally been the one that's the most difficult to deal with.
Hmm.
Number one, it involves capturing a lot of data and just, doing things like spreading financial statements, looking at bank statements, all that kind of stuff. It's cumbersome to calculate, and lenders have always been looking for a better way to use it. So, so anyway, that's sort of the background and just sort of why, how, when you're approaching lending,
Hmm.
this is sort of the baseline that everybody starts from.
Got it. And so just to kind of make sure we're clear on the four C's and sort of how data fits into these, credit is traditionally like what we're looking at with credit files and
Yeah.
repayment history and that kind of stuff, right? And then
Yeah.
collateral is obviously incredibly important when you're doing collateralized lending, right? So if it's auto lending or mortgage or whatever, you have to evaluate the value of the item that you're helping someone purchase or that they're putting up as collateral. That can help mitigate the risk that you're taking if the borrower doesn't repay their loan. I'm sorry, what was the third C before we get back to capacity?
Capital. So basically,
Capital.
just what are, what's typically in like a secured lending situation, what is the what level of capital is a borrower bringing to is it as an injection into a lending a collateralized loan.
Got it. Right. So they're
Yeah,
what money are they bringing to the loan, and again, in order
right,
to sort of like buy down the risk for the lender. And then,
right.
as you outlined, capacity is the fourth and kind of most troublesome C, right? Which is
Yeah.
essentially like what is the financial capacity of the borrower. And so, I think in a simplified way, the way that people have usually approached that is to sort of substitute like income for capacity, right? So we'll say, oh yeah, that's income in a like a credit card lending context. In 2009 with the Card Act, you were required to start looking at a consumer's ability to pay, and so you'd start to do
Mhm.
like debt to income ratios and some of those types of calculations. But fundamentally, we're looking at how much money does the customer have, what is the sort of amount of money they get paid, the steadiness of the income that they're getting, and factoring that into your lending decisions to understand if we add one more debt obligation to the plate of this individual or this business, what is their capacity to absorb that and be able to handle that obligation? Is that a fair way to think about the four C's?
You know, so that's absolutely a great way to think about it.
Okay. So then, building on what you just said, capacity is the troublesome one because we've had maybe sort
Mhm.
of a difficult way to evaluate it. It's very manual to assess, right? Like bring in a shoebox full of your bank statements, get me a copy of your W-2. There's like a lot of paperwork associated with it. Depending on the level of sort of certainty that a lender needs, they might try to verify the information that you're providing. And so like there are whole businesses that run on basically just, hey, this lender needs verified income. Can you call up the HR department at this company and verify that this person is actually still employed and is being paid this amount of money? That's very common in like mortgage lending, as you might imagine. This is like a very manual, very difficult, and kind of not fully comprehensive view of what we're actually trying to get to from an underwriting capacity perspective. So, can you then talk about how you termed it in the report, which is the fifth C?
Yeah. So when you if so for exactly all those reasons, when you talk about capacity, it's its use, the use of income and debt ratios is sort of fraught with assumptions.
Hmm.
You're in a lot of the the verification work that you mentioned is geared towards providing some level of certainty around that.
Hmm.
The what cash flow data is really kind of a multidimensional view of that.
Hmm.
One way I like to think about it is just if you think about cash flow as like a river, the
Hmm.
water that's flowing through a river.
Hmm.
If you're just looking at capacity, it's only telling you what the water level is.
Hmm.
It's not if you have the difference between capacity and cash flow is the cash flow data is really telling you what's going on, what the currents look like underneath it. Are there objects below, on the surface that are creating
Hmm.
that?
Hmm.
So it's, just if I'm piloting a boat down a river, those are the things I want to know. Likewise, if I'm a lender, just knowing the water level is, it's fine, and that's one aspect of it. But if I want to go deeper, and truly understand how a borrower is their, the sort of the stock and flow of their financial situation, cash flow is superior in that regard. So it really kind of gives you that multidimensional view of
Hmm.
a borrower's finances and how they're using their data or how they're using their income,
Yeah.
and then and just how just the volatility of it and all that.
That's awesome. Yeah, I mean, you have a great set of graphics in the report that sort of
Mhm.
illustrate that water level concept of when you look at it from and listeners won't be able to see me drawing with my finger as I'm talking, but when you look at
Yeah.
capacity or you look at like income or kind of simple debt ratios, you get sort of this flat line, right? This water level that Tim is talking about, where it's like, oh, they're roughly about here. So in a rough sense, we think they have the capacity to take on this extra debt obligation. But what you're describing, Tim, is that the actual day to day, week to week, month to month reality of a consumer or business's cash flow is much more volatile just naturally, right? Because you have money coming in, you have money coming out, the bills that you're paying hit at different points in the month, you have surprise obligations that come up at various points. Mostly you have sort of steady or predictable income, but if you're a business, that income also might be somewhat seasonal. If you're an individual, you might have a second sort of side gig, like a consulting business where you're bringing in a little money, but it's kind of a lumpier cash flow. So the summarized view of Alex Johnson, how much money did you make in 2024, doesn't really tell you the actual week to week volatility of my cash flow. Whereas cash flow data built on top of bank transaction data that either the bank has or that a consumer or business are permissioning to share with a lender, that gives you that more multi-dimensional view that you're talking about. So, Tim, I'm going to ask just a really dumb question because this is my specialty, but I think it's important because I had never really thought to answer this question in the detailed way that you answer it in the report. So I'm just going to ask the basic question. What is cash flow data? Like when you actually like, I can tell you, oh, it's bank account data that gives you a view into your cash flow. That's an easy answer. But like in a more precise way, if you think about it from a credit risk officer perspective, like what is it? How do you kind of categorize it or break it down into different components?
Yeah. No, it's a great question, and I think it's core to really. I mean, when you're talking about working with the data source and using it for some sort of prediction,
Hmm.
understanding it at that level is really important. So it's a great
Yep.
question. The way that I think about it is I like to think about things as spreadsheets. So like you have rows and columns.
Yep.
Cash flow data generally has four categories. So and then it'll have three dimensions within those categories. The four
Hmm.
categories are operating cash flow. So basically, like, what's your day to day cash flow expenditure? What are you spending your money on? Just sort of the stock and flow of just, every day, using your debit card or writing a check or whatever. Then
Sure.
there's financing cash flow, which is basically what, the sources and uses of cash from credit obligations to either draw from them or repay them
Mm.
on a daily or monthly basis. Third category is event data. So basically, like things like non-sufficient funds, like there's an NSF transaction or an overdraft or something like that. And then the fourth category is balance data, which is basically it's the water level in the bathtub or the river, if you
Mm.
will.
Hmm.
So, and just sort of how that moves over time.
Hmm.
So now within those four categories, there are generally four dimensions. The first dimension is velocity and growth, just in terms of trending associated with any of those four types of categories. There's volatility, which is going to be things like consistency and variability. And then the last category is behavioral changes. So if you see shifts or variations in patterns or tendencies, an example of that might be something like, the increases or decreases in the mix of card or ACH transactions or something like that. So basically, just trying to identify sort of a point of inflection in behavior, if you will. So that's
Yeah.
the way that I think about the data.
That makes complete sense to me. And it, I think, illustrates just how, like, actually deep this data is, right? Because it's like,
Yeah.
again, you think about cash flow, it's tempting to sort of think about it as like, oh, maybe we're adding one additional attribute to our model or whatever. And it's like, it's actually a whole universe of additional attributes, some of which are, to sort of put my old Zoot Enterprises hat on, like, very simple kind of calculated attributes based on kind of the raw data that's coming in. What is their balance? What is the total amount of money that flows out of the account every month? That kind of stuff. But then it also layers in a whole bunch of, I think, more complex attributes that touch on some of those things that you're talking about, the like dimensions of the data, right?
Mm. Yeah.
Volatility, behavioral changes, like things that you can look at by looking at the sort of relationships between these different variables and how they change over time. Um, Slight sort of bonus question, but one I'm curious about, Tim. Um, in your experience looking at this data, can you talk a little bit about like depth or history of this data? Because I think the other thing that comes up a lot with cash flow underwriting is if you compare it to like income and the ways that we measure capacity, a lot of times that's very much of like a snapshot of just the most recent period. Like, I'm going to get a mortgage. They need to know that my income right now is X because that satisfies these obligations. A lot of it is like what is happening right now in your life. Cash flow data, though, depending on the source and how much depth you have, can give you a visualization of someone's cash flow situation, not just today, but stretching back over a period of time as well, correct?
Yeah, that's correct. I think, and one of the things that I found when I was doing the research and talking to, some of the folks that I interviewed on this, I got some different opinions on, which was more valuable, sort
Mm,
of the depth of it or the recency.
mm,
From a business lending perspective, everybody that that practitioners seem to be more, they're focused on the depth and the history and just sort of, having that, having a pretty decent sized runway, if you will,
sure,
to
sure.
understand, the long-term trending. On the consumer side, it seemed like people were a lot more, the real experts in this field are focused a lot more on the recency and just sort of
Mm,
what's happening now. So I mean, and maybe it's just I think I don't think there's a right answer or a wrong answer necessarily, but it's kind of interesting how. But anyway, to answer your question, you can go back. 12 months typically is as
hmm
far as you want to go back,
hmm
but just depending on the particular type of lending you're doing, there may be emphasis within those timeframes.
Well, I want to talk about that because I think,
Mhm.
like, let's hone in on recency as one example, right?
Yeah.
I You present this data, and I think this is how I feel about it as well,
Mhm.
as like in a lot of ways deeply complementary to the ways we already do this
Yeah.
in the data that we already have, right? And as you said,
Yeah.
like credit data is amazing. It works extraordinarily
Mhm.
well for a lot of purposes. It has a lot of, I heard this term when I was working at FICA that I was really liked, which is caloric value, right? Like if you think of like
Yeah.
different data sources that having different levels of calories, like there's a
Yeah.
lot of caloric value in credit data and repayment data, which we
Yeah.
know. But there's also a lot in cash flow data and understanding a borrower's financial situation. And recency, I think, is a really interesting point to kind of double click into, because I think one of the biggest concerns that lenders have, and sounds like this comes up a lot on the consumer side in particular, is we're not quite sure if the data that we're getting here is the most recent reflection of what's going on with this consumer, right? Because credit bureau data is a little bit old. There's a lag associated with furnishing data to the credit bureaus, and there's a lag in terms of any things that happen to a consumer's ability to handle debt that then takes a while to work its way into the credit file, right? So the example I always use that's like a very simple one is, if you have a like something that happens in your life that sort of introduces financial stress, like let's say you lose your job, right, as an example, or you're about to lose your job, there can be a very long window of time from this person lost their job to this person has burned through all of their cash that they have as a buffer to sort of handle debt obligations, to this person has been pushed to the point where they have to make strategic decisions about their finances and how they're going to get as much liquidity as possible and then manage their obligations without having as much income as they used to then starting to see choices they make about which bills they pay back and which ones they don't, which then takes some time before it filters in as data furnished to the credit bureaus, which doesn't happen in real time. It happens on sort of a rolling basis, to then having your score be updated and I as a lender getting a view into what's happened to your capacity. So if you think about it from a lending perspective, and you lived this life for decades, right? Like you're constantly living in fear of like, what do I not know about this borrower that could end up causing me a problem? Well, in a traditional credit bureau context, there could be a lot happening in their financial situation that you don't know that's going to show up a week from now or 2 weeks from now or a month from now or a month and a half from now that could completely change the decision that you want to make. Cash flow data, by contrast, is a much more real time view into those factors that affect someone's sort of view of your credit worthiness. So, can you kind of talk a little bit about recency in that context and why it's so important?
Yeah, no, that's that's a great point, and I think this is one of the reasons why I think cash flow data has broader implications for how the financial services sort of if you think about credit information, it's
Hmm.
a big push model for the data. So
Hmm. Hmm.
basically, I lend, as a lender, I lend the borrower, they either pay or not. And then the lender will report that information to the credit bureau. The credit bureau gathers it all up. They aggregate it. They have their matching algorithms that basically match up the header data to the trade lines, and they build a
Hmm.
credit file from it.
Hmm.
Depending on the timing of when that lender reports the data and the timing of when you're accessing it in the form of a credit report, you
Hmm.
can typically the data can be as a trade line can be as old as 59 days potentially.
Right.
It
Right.
Yeah. And then if you contrast that with cash flow data, it's this giant pull architecture. So basically, what
Mm.
it's doing is, as a consumer,
Hmm.
I'm permissioning and I'm allowing the lender to go to access the data, but it's pulling almost, I mean, near, if not real time, then near time. And the data is much fresher.
Hmm.
And from the state, and particularly, when I started off my career building risk models on credit data,
Hmm.
one of the things that generally appeared as an attribute in any credit model that I think I ever built was, how many trade lines has a borrower opened in like the last 90 days or something like that? Because really what
Right.
you're looking for is just sort of like, sort of an increase in the demand for credit, if you will.
Hmm. Hmm.
The cash flow data can do a much better job of that because it's capturing much more signal and much newer signal
Hmm.
than credit file data. So yeah, I mean, in that regard, it has some tremendous advantages.
I'm glad you mentioned that one because that's my favorite go-to example for explaining this, right? Is like
Hmm.
the way I've sort of thought about it is we've had traditional credit data since what in its sort of current form, like the mid 1980s, right? I think the
Yeah,
first general purpose FICO score was like 1989, right? So like we've had it
yeah, I think
for
so. Yeah,
a long, long time, like,
yeah,
30, 40 years.
yeah.
And in that time, as smart people will tend to do, smart people like you sort of like squeeze as much predictive value out of the data that you have access to as you possibly
Mhm.
can, right? And so, I mean, you
Yeah.
know this very well. Like these large
Mhm.
banks, they have floors in their building with people who all they do every day is dream up new ways of coming up with attributes to slice up credit data and squeeze a little bit more predictive value out of them, right? And so we get very clever at trying to squeeze what I would sort of consider to be non intuitive answers out of data
Mhm.
that's not really designed to answer that question, but that we can sort of directionally infer things. And, as you just discussed, like inquiries is such a great one, right? Because people are always really
Mhm.
confused when they look at what are the factors that go into your FICO score? What can hurt your credit? Well,
Mhm.
too many inquiries can hurt your credit. Well, okay.
Right.
Why is that from a first principles perspective? Well, it's because, well, there are certain circumstances, like if I'm shopping for an auto loan or a mortgage, I might, go to five different lenders and have them pull my credit file and look at, my credit data. There are legitimate reasons why I might have a large number of inquiries in a short period of time. One reason I might be doing that is that I'm trying to load up on credit and I'm trying to get access to extra liquidity. And the thing we're trying to back into by looking at that is, well, why are you so desperate for credit? What demand do you have for credit? Did something happen in your financial life that might require you to get more credit? Do you know something is about to happen to your financial situation that you're not sharing with us, adverse selection, that we might want to know about? Oh, a large number of inquiries, that might be a sign of that. Well, that's a
Yeah.
very magic 8 ball way of trying to get to the question we're actually trying to answer, which is what
Yeah.
happened to your financial situation recently that is
Yeah.
causing you maybe to do these things? Well, inquiries is a way you can back into that answer in a very noisy, indirect, potentially sort of from a regulatory perspective, problematic way. Or you can just look at their cash flow data and go, hey, they normally get paid this Tuesday and they didn't get paid. What's going on? Right? Like that's a much easier way to answer this question. Or, wow, they just paid a large medical bill that they normally don't pay. I wonder how that's going to influence the overall water level and how they can handle obligations. So that's just, it's such a more direct way to answer essential questions that we've had these workarounds to answering prior. Is that fair?
Yeah, that's a great way to put it. Whenever you're building a model, just in your
Mm-hmm.
whether it's, I mean, whether you're applying it in business rules or just or models or parametric
Mm-hmm.
models or whatever, there's the notion of signal and noise in the data,
Yeah,
and for exactly the reason that you mentioned, things like inquiries, they'll, all things equal. Inquiries mean, recent inquiries mean there's some demand for credit or something
sure,
like that. You
sure.
know, I could be out shopping for a car,
Right, right.
and I don't
And
have any
and FICO
control
has
over
had to
that.
adjust their models to
Yeah,
compensate for
ex-
legitimate
exactly.
use cases that don't indicate risk,
Yeah,
right? But it's like,
yeah,
yeah, like
yeah,
there's a demand for credit. What does that? The question is, what does that
yeah,
mean, right? And I'm guessing from
yeah,
your perspective as a modeler, that's the thing you're
yeah,
always trying to sort of. This is the art and science of it,
yeah.
right? Is that the
It
science
is.
suggests if you run all the different variables and you look at correlations and predictive values, this has some predictive
Mhm.
value. But the question you're actually trying to answer from an art perspective is, what does this mean? What is the borrower doing that might indicate greater levels of risk?
It's looking for new data sources that are going to be more signal than noise, and I think one of the things that cash flow. I mean, like you said, cash flow data is it is pure signal, just about.
Totally.
Yeah,
Totally.
yeah.
Yeah, no, I mean, pure signal is a great way to put it. Maybe we should make that the title of the report. I'm thinking about it because that's a really great 2-word summary of exactly what we're talking about. So, to wrap up, I have a couple last questions for you. First one
Sure.
is, and you outlined this really well in the report as well, but just kind of briefly, cash flow underwriting is the term that's used. And so I think it's very intuitively obvious that the underwriting process is a place to start here. But there's sort of some nuance there. One is underwriting is one place where cash flow data can add value. It's not the only place in the life cycle of lending where it can add value, right? So there's this whole other dimension around servicing. And then even within underwriting, just because you're going to apply cash flow data when you're underwriting a borrower for a loan, there's multiple ways of actually like implementing it. So can you just add a little nuance to, from an underwriting perspective, different models for integrating this data, and then talk a little bit about how it can go beyond underwriting as well?
So the way that I like to think about this is just when you think about the different uses for cash flow data, I think,
Hmm.
what I try to do is I decompose, what the components of what you're trying to predict, in the way of credit risk. So that takes the form of, the formula for expected loss is the probability of a default, times the loss given default. There's
Hmm.
also a component called exposure at default, which is basically like an assumption around, what, for the amount of credit that's outstanding that isn't used, what percentage of that will wind up in a loss. But
Hmm.
generally, it's probability of default and loss given default.
Hmm.
From a, uh, probability of default is really, I mean, that's basically like a FICO score or a Vantage score. It's like,
Sure.
what are the odds? Loss
Hmm.
given default really kind of depends on, the product, the collateralization, all that sort of stuff. So it's
Hmm.
very product driven. Cash flow data, it creates value, and it's valuable not only in establishing, or improving the quality of the prediction from a probability of default basis, but also from a loss given default perspective. Because let me, and then one of the terms that you hear pretty often when you're talking to people about cash flow data, and those that are the closest to it, is orthogonal. It is truly orthogonal to credit risk. It's from a probability of default perspective. It's very predictive of probability of default, um, but it's in a completely complementary way to credit data, which is very powerful, because basically
Hmm.
the combination of the two, renders the maximum level of prediction. From a
Right.
loss given default perspective, that it's also predictive there, because it's an enhanced view of capacity, and
Hmm.
just sort of understanding sort of the sources and uses of cash, from a consumer or a business. So those are kind of the two use cases for, originations. Most of the time, it's going to be like second look programs, or you're using cash flow data in a matrix fashion, with credit data. So
Hmm.
and then there's using it to establish credit line or loan amount. On the account management side, you can use it for also. There are a number of use cases that are emerging. One is, sort of an obvious one is using it for account monitoring. So basically, the same way that if I'm a lender, I get a FICO score refreshed every month or something like that. I can use cash flow data in that regard. One of the things for particularly on the business lending side for lenders that have the flexibility to be able to do this, being able to basically manage the terms of the extension, and just matching up due dates and sort of the timing of repayment to the timing of cash flows and the timing of of inputs or revenue coming in. That's really powerful. And one lender that I spoke to, that I mean, and they're pretty innovative. They said they were able to reduce their loss given default by as much as 50%.
Wow.
And so, I mean, it's very powerful, and they raved about it.
Hmm.
So anyway, yeah, it's a tremendous capability. So hopefully that gives you a better sense of sort of the account management and the origination and underwriting
Yeah,
use
no,
cases.
that I mean that makes total sense to me. I'm becoming more of a nerd, I guess, on the cash flow servicing side, just because, like,
Yeah.
I think it's funny, right? It's like underwriting is always where everyone focuses. And it's because, like, hey, this is exciting. This is where we're making the decision. This is where we're taking the most risk. This is where we have the biggest potential to drive greater profits or bring more customers in or grow. So, like, it's always decisioning and underwriting and account opening that gets all of the shine. I really do think servicing might end up long term being the bigger beneficiary of cash flow data. And my sort of general intuition for that is that, as you outlined, we use such rough tools for managing people's payment obligations, right? And it stretches from account management and portfolio review all the way into early and even late stage collections, where it's like, it's just wild to me that we do things like trying to collect on debts by, just essentially bothering consumers until they pay us back without any insight into, like, what their cash flow situation is or what caused them to stop paying or what you could do to help reshuffle their overall cash flow situation so that they can get back on track. And some of that work happens manually when a great collections person talks to a customer on the phone, but there's no automated way to do that. There's no sort of model driven way of doing that without the right data, and cash flow data is that data. So I'm becoming a big servicing nerd. I also think, and maybe this is a subject, Tim, for a follow-up report, there's a whole, like, secondary market securitization sort of angle to cash flow data, which we probably don't have time to get into, but maybe we can just tease that as a topic to get into some point down the road. Let's wrap up with this. I would like to have you put on your prognostication hat. We're still early in 2025, so 'tis the season for predictions. 5 years from now, how common do you think cash flow underwriting will be among banks and credit unions? And how do you think the lending experience for consumers and business owners is going to look different?
Yeah. Great question. I think, and I don't consider this to be really a hot take necessarily, but in my view, I really believe that 5 years from now, cash flow underwriting will be a peer to credit, to the use of credit information.
Wow.
I think just, for all the reasons that we've talked about, just, sort of the recency of the data, the comprehensiveness, its orthogonality, it is truly different. And I think it had, like I said a little earlier, I think it really has broad implications for how, credit information and external financial information that's used for underwriting is obtained.
Hmm.
I think, with 1033 coming along, I think one of the things that, talked about in the report was just, the notion of, if I'm a lender and I'm not engaging in the use of open banking source data for underwriting purposes, my competitors are. So it's just, it's the analogy was You don't have to outrun the bear. You just have to outrun the other person that's outrunning the bear. If a lender, just by default is not using it, they're at an inherent disadvantage to the rest of the market. And I think for that reason, you're gonna see really broad adoption over the next 4 to 5 years. And I think real so. And then if you look at the predictive strength of the data, it is very comparable to credit data, just at a standalone basis. FinReg Labs has done some great research on
Yeah.
sort of comparative predictive strength of the two, just individually and then in a combined fashion, and it
Hmm.
holds up really well. I mean, it's an equal to it. I think the one thing that's going to need to happen, and I think it will, the one of the reasons that credit information is as valuable as it is just simply because it's well understood. I mean,
Yeah.
there's a common format like the Metro 2 format and all that. I think, and just recently, the CFPB recognized one of the first standard setter when it comes to
FDX.
open banking. I
Yeah.
can't. Yeah, yeah.
Yeah.
So
Financial data
that's
exchange. Yeah.
yeah, and that's big because basically the establishment of standards and just sort of a framework that
Hmm.
it creates, it kind of fixes the target, if you will, and makes it more
Hmm.
stationary from a modeling and prediction perspective. So, with that level of maturation in the ecosystem, I think that's one of the remaining items that I think needs to take place, and it's
Hmm.
it's really once that, as that matures, I think you're going to see cash flow data and credit data pretty much on equal footing.
Yeah, no, I think that's exactly right. And just to add my 2 cents on top of that, the maturation point is really well taken, right? Because as you said at the beginning, like credit data is actually really powerful and really great. And one of the sort of underrated things about it is that standardization and also the fact that it's not high friction for customers, right? And I think that like historically, that's always been the concern with open banking as a driver of cash flow underwriting is, oh yeah, but like, how reliable are the connections to these other data providers? Will consumers or business owners really agree to permission this data? Will it freak them out if they, give permission to access my bank account data? Do those providers count as consumer reporting agencies under the FCRA? How much friction is there going through the permissioning process? Like, it's all the little questions. It's not the big question of like conceptually, does this make sense? That's been clear for a long time. And as you said, FinRegLab and others have done a great job kind of adding quantitative evidence around that. It's all the like little kind of implementation questions that are sort of death by a thousand cuts and that you just don't really want to deal with. It's all those areas I think where we've made a lot of progress, right? I mean, consumers and business owners are much more comfortable today than they used to be permissioning access to their data and using it to get a value exchange in return. There's much more regulatory clarity around, all of the big data aggregators for the most part have become CRAs and are sort of embracing FCRA and the obligations that come with it for cash flow underwriting. You even have examples like you're saying with 1033 and the CFPB. Like, is that really going to change anything? Well, I think one thing it could change is just the reliability of this infrastructure and the fact that it will run on standards and there will be requirements around uptime so that lenders will be more comfortable relying on this infrastructure. So, all of those little things individually, no one of them seems like a big deal, but collectively they kind of raise the almost the level of quality so that this infrastructure can operate at the same level of reliability and consistency and quality that the credit infrastructure relies on and runs on. And when they're at par, I think you're exactly right. Like the use of them will become that much more equal. And in some cases, for folks who are new to the credit ecosystem, they're going to start with cash flow data, right?
Absolutely. Yeah. I think, and just from an event, we didn't really talk about this very much, but it's a great point to emphasize.
Mm,
Just in terms of the universe of lendable, quote, lendable, borrowers that are out there, the ones that don't have
mhm.
credit files, they're gonna, they're much more likely to have, some sort of a banking relationship or a deposit relationship,
That's right.
which makes them which makes them, sort of sourceable from a cash flow perspective. So it's a great
Hmm.
universe expansion tool and I think the CFPBs recognize this. They've been
Hmm.
very overt about, just from an access to credit perspective, this is a great tool.
Yep, yep. And I think that regulatory support for it clears a
Hmm.
lot of the barriers out of the way, right? Like
Yeah.
banks and other lenders don't like to try new things. They always like to be second, not first on this stuff. But I
Hmm.
think that a big
Yeah.
sort of concern they have with that is always, well, like we're trying to do a good thing or we're trying to improve things for customers, but will we get kind of the grace from regulators to try this? Maybe,
Yeah.
to run into a couple
Yeah.
roadblocks and to have the occasional problems crop up. Like, will we get any grace from regulators as a part of this? I think as it relates to cash flow underwriting, the answer regulators have been signaling, and this will be true, I think, under the Trump administration as well, is clearly yes. Like we want to see
Hmm.
the market move in this direction. So, Tim,
Yeah.
with that, I will let you go because I've taken already too much of
Thank
your
you.
valuable time.
It's
I
great. Been
really
great.
can't express enough how awesome this report is. Tim like dropped this final version essentially in my lap, going like, "I hope this is good," and it's amazing. It's really, really good. It's in depth. I think everyone will learn a lot from reading it. So I will be sure to include a link to the report when it's ready. And Tim, again, thanks for taking some time to walk us through some of the findings.
Yeah, thank you, Alex. This has been great and a lot of fun, and I'm looking forward to getting it out there and having the opportunity to discuss it with everybody. So thank you.
Absolutely. My pleasure. We will be back with another podcast next week. Thank you.